Hey YouTube, welcome to the Subprime to Prime YouTube channel. Here our focus is to get you from subprime to prime, and that all starts with knowing where you want to go on our financial journey. And this is for information and educational purposes only and not intended to be financial or legal advice. And please hit that subscribe button and that like button for more content on all things financial literacy. Alright, let's get into this video. Okay, in this video we're going to be talking about and understanding how inflation kind of erodes wealth. And as we've seen, if you're watching any kind of news or reading any of the financial reports or newspapers or anything like that, you're always constantly hearing about inflation, and how it's going up, down, whatever have you. Now, I just want you to understand a kind of a more simplistic explanation on how it reduces purchasing power, how it devalues savings and impacts your investment returns, and overall it increased costs and uncertainty in the markets, and and strategies to kind of combat that. So let's start with kind of understanding how inflation erodes wealth, and it's crucial for both your personal finances and investment financial planning as we're moving along here. And it's kind of so you understand, like the concept of $100 today will cost $103 next year. And it's like kind of the most direct way that inflation reduces our purchasing power. So over time, if your income or investments don't grow at a rate that outpaces inflation, you will be able to afford less and less, basically. So understanding that and really letting that sink in, I always tout to save for an emergency fund, save, anyway, and invest in those things. But what I'm talking about and trying to explain to you is we're talking about on a very granular level. This is if you're kind of starting out your journey and you have to start over. This isn't if you are fully established. It's even worse if you don't let your money work for you. But at first we got to get the money. We have to really deploy it and leverage it and use it wisely so that we can begin to keep and have more of it by increasing what we bring in versus what we spend or let go out of our financial house. But this is still important to the point that we have inflation, but on this level where we're beginning and learning and understanding it, you have to have it in the back of your mind that the dollar won't be worth what it is now tomorrow, so to speak. So you have to plan for that accordingly. And that's why I implore you, the faster you really take this serious and really jump on getting your finances in order, and as quickly as possible, because really time is of the essence. It really is. And I don't want to have you thinking that you have all this time in the world to get things in order. You're going to be doing what you need to do anyway. But there's no reason why you would wait any longer than right now. The best time to start was 10 years ago, and the next best time is right now. So understanding that money saved in a traditional savings account often earns interest at a rate way lower than the rate of inflation. This means that the real value of your savings decreases over time. For example, if your savings account earns 1% interest annually, but inflation is 3%, your savings are effectively losing 2% of their purchasing power each year. Okay? So let that sink in. If the bank's paying you 1% and we have inflation of 3%, you are losing 2%. Just very simple, basic math. When we're talking about, simple interest. Okay? Now, it does compound over time. And, your investment returns, inflation can also, erode the real returns on your investments. For instance, if you earned a 5% return on an investment, call it any investment, but inflation is 3%, your real return is only 2%. So for investments with fixed returns, such as bonds and high inflation, or high inflation can significantly reduce that by 3% if you were initially earning 5%. So it's just, again, something to expose you, something to keep your mind open about. Now, the increased cost and uncertainty. So for businesses, inflation can lead to higher costs of materials and labor, which can eat into profits and reduce the value of stock and other investments. Additionally, inflation can create economic uncertainty. People aren't trusting that you're really, in the back of your mind, you're like, the last major thing that we had to deal with was COVID and how it affected the supply chain. And now overall, even before COVID, during COVID, now after COVID, we're looking at the spending of our government is increasing, or has increased over time. There is no time where there's nothing spent by the government, but in this last decade, we've really accelerated that due to certain impacts that affected us as a nation. So it's here. It may go down, it may go up. We don't know. We see what the Fed is trying to do by alleviating it and pushing it downward, but consumer trust and what the markets, we really definitely have no control over what that's going to do. Now, it also has impacts on loan. While inflation can erode savings, it can have a mixed impact on debt. So if you have a fixed rate loan, inflation may effectively decrease the real amount you owe over time, since you're paying back a loan with money that's worth less than when you borrowed it. So when you think about it, for variable rate loans, as inflation rises, the interest rates may also rise, and you kind of increase the cost of borrowing overall. So inflation has huge implications, and I just wanted to talk about it and expose you to it. If you really haven't dialed in and broken that down on how it affects those particular areas of your life, this is what it does. Now, here are some strategies to kind of combat inflation. You want to invest in assets that outpace inflation. Even though when we're talking about that 5% return, it's still overall outpaced the negative 3%. So you still came up above. Now you need things that hedge a little bit higher than that so that your returns are a little bit more healthier. and you want to focus on the ones that have historically offered returns that exceeded inflation, like stocks, real estate, commodities. If you want to learn about those things, take the time to read the books, or go to the experts that can explain those things to where you understand them better so that you can invest in them, right? Okay, and you want to diversify your portfolio. You don't want to have all your eggs in one basket. That's like the simplest way to put that. And, including a mix of asset classes that you would have never, really thought to invest in. Securities like, treasury inflated or inflation protected securities, and bonds or things like that kind of, over time they always bounce back. Stocks have always bounced back. They dip and rise. That's, you want to buy everything on the dip and sell it when it's on the rise. You want to always be looking to increase your income. That combats inflation. Work towards gaining a skill that helps you get a side gig or start a business, or get that raise from the job that helps you bring more money in. You want to always budget wisely. That helps a little bit to scale off inflation too, so your money won't go as far as it used to. You want to be able to budget accordingly. So, and all in all, this is just one of those things that everybody has to face the music to. It's happening, but it's okay so long as you do things that hedge against it. So, we have a community group on the school platform called the Subprime to Prime group over there. So if you are interested in learning any more about all things financial literacy, hop on over, check us out, and we'll see you next time.